Hi everyone, we are back now to kind of go over several worksheets. So this first worksheet that we're going to be going over, I will upload a blank copy for y'all, is the bank balance sheet worksheet. I'm here today with my dad, Stephen Hayward. He was previously the Executive Vice President of the First State Bank of Elkhart. Is that correct?
Mm-hmm.
And so has 20 plus years in banking experience.
Mm-hmm.
So this is definitely up his expertise alley. So he's going to start explaining to y'all what's going on.
Okay, we're going to have three different sheets we do. The first one we're going to start out with this video is a bank balance sheet. This is like your bank checking account. This is what you have or what the bank has at one time. So first of all, the balance sheet has assets and liabilities and capital. So we'll draw a line right here. These are assets. These are good things. This is money you have. And this is liabilities and capital or net worth. Okay, so let me explain this. Deposits. This is money that the customers have loaned you. You got to pay it back. In the old days, if you watch the video of the goldsmith, they would bring gold into the bank. So in this case, there's $10,000 worth of gold sitting in the vault. You've given them paper receipts or a checkbook that says they can write checks against this. These are demand deposits. That's what makes a commercial bank unique, because you can go in and demand your money right now, and they have to give it to you right now. The other financial institutions can delay it a little bit. So right here, this is what the bank owes the customers. Now, net worth, this is what the bankers themselves put together to start the bank. And the reason it's in the liability side is because the corporation, the bank, owes that to the owners. So if we add this all up together, we get $12,000. Now, total liabilities has to equal total assets. So total assets are going to equal $12,000. And we're going to play crooked accountant here. We're going to force balances. Now, the government says if depositors put money in the bank has to hold some back and not loan all of it out. Theoretically, the bank could loan the full $10,000 in deposits plus the $2,000 in net worth, but we need some money left over. What if a customer wants to take some money out to buy a car or a house or something? So there's required reserves, is what they're called, that the bank needs to keep on hand. Now in this case, the bank's holding $1,500 in total reserves. That's either cash in their vault or money in their checking account at the Federal Reserve Bank. And we don't know either one, and it doesn't really matter here. Now, for this particular government, there's 10% required reserves, which means they have to hold 10% of deposits back in the vault. So the required reserves, 10% of $10,000 is going to be $1,000. Okay, but they're holding $1,500 in the vault right now, so that means they've got $500 that's in excess of the required reserves. Now they could take this $500 and loan it to somebody, but right now they're just holding it. Now what's left over here is obviously in loans or bonds, and we'll talk about bonds later. Well, let's talk about them now. A bond would be a loan by the bank to the federal government. A loan would be a loan to a customer. So in this case, we have $1,500 in the vault. We have $10,500 loaned out to customers. We owe $10,000 in deposits to customers. We owe $2,000 to the owners, and we balance. Okay? So let's work the second one through. So you should take your sheet that you have, if you downloaded it and printed it. So let's look right here. We've got 20% required reserves. We've got $10,000 in deposits. Again, I'll draw the line here. So we've got liabilities and net worth and assets here. Okay. So how much would we need in required reserves for this bank? $10,000 times 20%. or 10,000 times 0.2 is going to be $2,000. So how much would we have then in excess reserves? We'd have $500 in excess reserves. Again, let's add this up to get the total. We've got 12,000. And then loans, we're going to have 12,000 minus 2,500. So we have 9,500. I'm going to get some of you asked, now how did you do that again? So I'm going to work right in this box here. We've got 12,500, 12,000 minus 2,500. So we're using this number right here and this number right here to find that number. Now total assets is going to be, and I messed it up here, $12,000. Let's do one more. Now if you'll go on down, I gave you the answers. So let's go here. Okay, reserve requirements of 5%. Okay, $10,000 in deposits. So how much is 5% of $10,000? That's going to be $500. And you're going, that's a really small bank. Well, if you look at the actual things, it usually says in thousands. So that would be 500,000 here. Or sometimes it's in millions. That might be 500 million. But we'll just say $500 for this. So $500, so we have $1,500 in excess reserves. We add these two up and we get 12,000 and 12,000. So in this case we would have 2,000 in total reserves, 12,000 total assets. So we have $10,000 in loans. See, that's not hard. So this is the bank. Now banks have to do this every day, usually by 11 o'clock. Now what they'll do with this excess reserves is they'll make a loan. Some banks might end up not having enough in excess reserves, so they'll borrow the money, and this is called Fed funds. And it has nothing to do with the federal government. Just a real brief discussion here, because most people don't know where the term came from. Back in the farming days in the 50s, the government would pay farm subsidy to farmers using CCC checks, Commodity Credit Corporation, and those little checks would pay a small amount of interest. So the farmer would come into the bank and cash the check. The bank could send the check to the government and collect the money right then, or if they didn't have any loans, they would just hold the check and collect the interest until they sent them in. If a bank needed to borrow money and they had some of these CCC checks being held back instead of cashing them, they would borrow the money from another bank and use those CCC checks, which are federal checks, for collateral. And since they were federal checks, these were called Fed funds. So again, this doesn't have anything to do with the federal government per se. They're not borrowing from the federal government. So that's a bank balance sheet, and I think you are able to run it now. So we'll go on to the next one. Good morning again. Now we're going to talk about how banks fabricate money out of thin air. So this is the creation of money right here. This is almost creepy. So here's a set of banks. We have bank 1, 2, 3, and 4, and they will actually go on even more than that, but we'll just deal with those banks. So let's say a customer's coming in with $1,000. This is new money coming into the banking system, and they are a customer of bank number 1, and they deposit $1,000 in bank number 1. Now, on the prior lecture, we learned that banks have to hold out reserve, so this bank will hold out $100 in reserve, which means they can loan $900 of that money. So bank number 1 then loans to another customer $900 to buy a used car. The customer goes to the car lot, buys the used car, gives the $900 to the car dealer. The car dealer now has $900, and he goes to his bank and makes a deposit in his bank, which is bank number 2. So he makes a deposit for $900 in bank number 2. Now let's talk about these two deposits right here. Customer number 1, if he looks at his checking account, he has $1,000 in it, and he can go and withdraw that $1,000 anytime he wants. Customer number 2, the car dealer, he looks at his bank account and he's got $900 in it. We have just increased the money supply by $900. Now, bank number 2 has $900 that they can do stuff with. They have to take 10% in reserve requirement, so they're going to hold out $90, and that gives us $810 that they can loan. So they loan that money to a student that wants to go to WT, and the student goes and pays their $810 in tuition, and WT trots down to their bank, which happens to be bank number 3, and they deposit $810. Now, if WT looks at their checking account says they have $810. The customer to use car dealer, he looks at his, he has $900, and the original customer still has his $1,000. So the banks are, through multiple banks, fabricating money out of thin air. This is really, really creepy. Now, can it go in the opposite direction? Yes, it can, and you can shrink the money supply of the country. So anyway, we can work this out. So $810, we have to hold out $81. The bank can loan out $729. Then this money gets deposited into bank number 3, $729. And you hold out $73 and $656. And this can eventually go down to where it reaches 0. So if we add up all this money right here and go down, how much will we get? Well, that will take us a long time to do it, and I'm kind of lazy, and I know you're kind of lazy too, so what's the shortcut? I call this the shortcut to Grandma's house. Remember Little Red Riding Hood? She took the long way to Grandma's house, and the big bad wolf took the shortcut. So let's look at the shortcut. We're looking at a multiplier we can multiply the initial deposit to, and we can tell what it is, and it's real easy. So we take the reserve requirement, this number, so I'm going to write it right here in decimal form. 10% is 0.10. And you divide 1 by the reserve requirement. And you can fiddle around with it, but that looks like a dime to me. How many dimes are in a dollar? There's 10 dimes in a dollar, so you go right here. The money multiplier is 10. 10 times the $1,000 initial deposit will give you a $10,000 increase in the money supply. It's that easy. So let's do this again. Now, let's just theoretically talk about this. If the next bank has a 6% reserve requirement as compared to 10. So if the bank can hold out less money and loan out more, what do you think that's going to do to the money supply? Well, let's work this one out. 1 divided by 0.06 equals what? It equals 16.67. Okay? Excuse me. So 16.67 times, this is 16.67 times 1,000 is going to be 16,670, which is more than a $10,000 increase. So if we lower the reserve requirement, more money is available to loan out, and we can grow the money supply bigger, and we can stimulate the economy more. So right now, what did the Fed do? They lowered the reserve requirement to virtually 0, which means you can infinitely expand the money supply. Now, I saw a joke recently. If Mars invaded the Earth, the first thing that would happen is the Fed would lower the reserve requirement. That's a joke. Okay, let's get back to this. So we're going to have a $1,000 deposit here. How much do we hold out? We're going to hold out, well, my cheat sheet's wrong. Work your calculator there. What, 6%? That would be $60, right? And so how much do we have left to loan? 1,000 minus 60 would be 940. As compared to 900 if you look at these two. So it makes more money to loan out. So by lowering the reserve requirement, you get an increase in the money you can loan out. So you've got 940 here, and we're going to have to hold out 6% of that, which would be $56. And 940 minus 56 is going to be 884. And so on and so forth. And you can see how that works. So 884, and we can finish filling that out. But we can do the shortcut here and get the increase in the money supply. So let's do the shortcut here. If we have $1,000 in a new deposit, 5% in reserve requirements, 1 divided by 0.05, how many nickels are there in a dollar? There's 20. So the money multiplier is going to be 20, so 20 times 1,000 is going to be $20,000. So that's really all there is to this one. This shows the theory, again, how banks fabricate money out of thin air, and we have a shortcut to Grandma's house on calculating that. So very important, the money multiplier. Let's do a different color. Well, let's do a different color here. So the money multiplier equals 1 over the reserve requirement. That's your formula. Okay, we'll go to the next video in a second. Okay, let's talk about what the Fed does to stimulate the economy. So I'm going to draw over here at the side. So if you remember the Keynesian cross, this is our 45-degree line, and this is C plus I plus G plus X. If we need to, and this is our current GDP, and we do a Y, I don't know why, but we do. If we need to move this way, we need to shift the line up, and the way the Fed does it is they make more money available for businesses to borrow, which would be the I, and it will shift the total line up, and you'll get a new Y2. Okay, so how can we shift that up? They do it by inflating the money supply, so businesses have more money to loan, and they've done it. So let me erase this mess here. Okay, and if businesses borrow more money, let's look at aggregate supply and aggregate demand. So here's our aggregate demand, aggregate supply, and this is short run. And let's say we're right here. This is our long run aggregate supply, and we need to get from here to here, and we can do that by increasing aggregate demand. And we do that, this is aggregate demand 2. We can do that by giving businesses more money to loan, and that's what's happening right now during the coronavirus episode. The Fed's increasing the money supply. One way they can do it is by buying and selling bonds. If you remember back at the bank balance sheet, we had loans and bonds, and if the banks can get more money to loan, they can do it that way. So banks hold bonds where they've loaned money to the federal government, and they can buy bonds or sell bonds, and we'll, as we go through this. So let's go back. Remember what we learned where we had, let me get a new color here. So we have a 10% reserve requirement, so 1 divided by 0.10 will give us 10 dimes in a dollar. The Federal Reserve Bank buys bonds from the banks. So let me erase this so I've got some more room here. Okay, so we have a bank here and the Fed here. And we have a piece of paper that's a bond. In this case, the Fed's buying the bond, so the bond's going to go to the Fed. The bank had the bond. And so the Fed, to buy the bond, is going to ship dollars to the bank. Once the bank has the dollars, they can loan the money. So there's going to be an upward change in the money supply. How much? 10 times the multiplier, $1,000 times 10. So we're going to inflate the money supply by $10,000 with a $1,000 bond purchase. And I suggest on the test, you actually draw that picture on a scrap piece of paper. You'll be doing an online test from now on. So now we'll look at a 12% reserve requirement. If we do 1 divided by 0.12, we get 8.33. Okay, so 8.33 times $1,000 is going to be 8,000, and you can run it out. We're not picky, this is macroeconomics. And we want to shrink the money supply. So if we want to shrink the money supply, the Federal Reserve Bank will sell a bond. So think of it. The bank gets a piece of paper that says the government owes them money in the future, and they have to pay for it, so they give the Federal Reserve Bank money. When the Federal Reserve Bank gets money, it leaves the money supply. So in this case, we're going to do a sell because we're lowering the money supply. Now, what will this do to interest rates? Let's look at this. We're going to go down here and look. So here's our money demand, and we write interest rates in little r. And this is our quantity. And the Fed determines the quantity of money. So this is the supply of money. So if we shrink the money supply, we're going to move the supply curve to the left. So this is our first interest rate. This is our second interest rate. The interest rate goes up. When the interest rate goes up, businesses are less likely to borrow money and do expansion. So in this case, this is what should have been done in 2007. The Fed should have shrunk the money supply, raised interest rates, and slowed down the heat in the system. Now, let's say you don't know what the Fed's doing, but you find out they're buying bonds. What's that going to do to the economy? So if they're buying bonds, where does the money go? Fed calls up the bank and says, I want to buy a bond from you. I'll pay you cash. So cash is obviously going from the Fed to the bank, and that will be an increase in the money supply. 14% required reserve, 1 divided by 0.14, will give us how much? It'll give us a money multiplier of 7.14 times $1,000 will give us 7.14, and if you work it out, 7,143. Increase the money supply. What do you think that's going to do to the interest rate? Well, if you come down here to the graph, if we increase the money supply, we've got interest rate 3 right here. The interest rate will drop. Let's do one more while we're at it. So we have a reserve requirement of 8%, which 1 divided by 0.08 is going to give us 12.5 times 1,000 will give us 12,500. Now the Fed's selling bonds, so if the Fed sells it, the banks have to give the Fed money. If the money goes into the Fed, the money supply shrinks, which means interest rates will increase and business activity will slow down. As you can see, you have several more you can work, and you can see how it works out that way. So that's what there is. Open market policy is what the Fed primarily uses to change the money supply. The second, while we're at it, the second way they change the money supply is the Fed will loan money directly to banks, and that's called the discount rate. Okay, discounts is an old-fashioned term for a loan. I won't go into the reasons why it's called that, but this is the number one. The open market policy, that's the number one tool they use. The second tool is the discount rate. And the third tool they use is changing the reserve requirement. Now, if the Fed changes the reserve requirement, there will be massive, huge changes in the money supply. That's why this is rarely done and done usually only in an emergency. And with the coronavirus, that was an emergency. Chances are you will live a big chunk of your life and hardly ever see the reserve requirement changed. Discount rate changes somewhat regularly depending on economic conditions. You'll see maybe 2 or 3 times a year where the discount rate is changed over a normal economy. Open market policy, they do that every day, all day long. And if you'll get a little deeper into it, what they're trying to change is the federal funds rate. Remember, that's the rate that banks use to borrow money from each other, but it's done through the open market policy. It's done in a sealed room. Nobody knows what's going on there. And the creepy thing is we don't elect the Federal Reserve Board, so our economy is being controlled by unelected officials, which might actually be a good thing because they're not under constraints from constituents and they try to do the right thing. So anyway, this is how the Fed changes the money supply to hopefully, in the short run, change the economy. While I'm here, one more thing. This will not affect interest rates in the long run. This is strictly a short run thing. So I'll leave you to go ahead and play with the sheets yourself.